This past year we did 1.3 million in premiums for 24 clients, and there's more that are starting to get closer to taking loans. Here's 2 hidden risks and how to avoid them. The first is overloaning, and this will apply regardless of where you're at in your policy when you're starting to take them. In this first example here, we have even if you can afford to take the loans, this needs to be done with a plan. So a little example here, let's say you're 2 years in, you were putting $1,000 a month in. So up to this point, you've put in $24,000. Your account value is $21,000. Your surrender value is $19,000, and we'll get into this here in a second. But what that means is you can access up to $19,000. That doesn't mean, however, that this would be a wise idea. Now, of course, something really comes up, you need $10,000 immediately, you can borrow that, use it for an emergency. Of course, though, we all know IUL is a very long-term vehicle. That's why we're 2 years in, we've put in $24,000 and we only have $19,000 we can access. That's because of those early year fees. Should have an understanding of that already. But if we take out $10,000 here very early on, we should have some sort of plan to pay this back, and likely the interest that loan accrues depending on which type of loan that you're using. Reason being, we're accessing about 50% of our money here. Now let's say that you're using this for retirement income in the future, you're putting a bunch of money in the future you want to take out money completely tax-free. Now once you've built up a nest egg, let's say it's $1 million, and you're going to start taking retirement income from that, depending on what age and how long into the policy that is or how much longer you expect to live, usually this is going to be between 6 and 8% of that number. So if you have $1 million in account value or cash value, you can take $60,000 to $80,000 a year income tax free. Now we only take 6 to 8%, number one, to make sure the money doesn't run out. And two, we are building up a bigger loan balance when we start to take money, and we don't necessarily want our loan balance to become more than, say, 80% of our account value, and that's over the course of the entire time that we're taking money out. So if that's the case well into retirement, you can imagine very early into the policy, taking more than 50% of your surrender value out is fine. You can do that for emergencies, but we want to make sure to get this money back in. Why? So that we can work back towards that goal of taking retirement income. Now, your minimum monthly premium here, that's $75. That's what I said I was going to come back to. That means in order to guarantee that this policy isn't going to lapse for, say, 15, 30 years, as long as you're paying $75 a month, it's not going to lapse. You're fine. The policy is going to stay in force. You can always make up for past money that you hadn't been able to pay into the policy. So if this is the case, 75 times 12, we have 750 plus 150, we have 900. And then if we multiply that times 2, you only needed to put $1,800 into this policy to guarantee that it wasn't going to lapse up to this point. You've put in $24,000. So you can ride this policy out without putting hardly any more money in for a very long time. Now, that will keep the policy alive. However, what is our goal? Just to keep the policy alive and to use this as insurance? Of course not. We're trying to use this for retirement income. So if that's the case, while you can do this, we need to keep the future in mind and make sure if we're going to access a big chunk of our money like that, let's make a plan to pay it back. Even if it's 2, 3 years from now, that's fine, but we got to get that money back in if we want it to work as illustrated. And the second, as I alluded to there, is overloaning when you're taking retirement income. You do need to keep an eye on this. The main thing here is doing annual reviews, but even if you set it at we're only going to take 7% tax-free a year and be done, we're not going to do anything fancy, we're not going to change it, we still need to take our annual reviews and realize it is possible that that number might need to be lowered. Perhaps you're going to be able to raise it. We need to keep an eye on it to make sure, like I said, that loan value hopefully doesn't get above 80% of our account value. Now you can go a little bit higher than that, that's just an arbitrary number. But this gets right into our second hidden risk here, is the market downturns and the effect they can have on the money that's not being loaned out and how that plays. There's 2 types of loans. So first, if it was a standard loan, which usually people will refer to as a zero wash loan, meaning you're loaning the money at, say, 2.25%, but the insurance company is crediting you an equal and opposite rate of return, so 2.25%. So you lose 2.25, you gain 2.25. It's like a zero wash. So this is the less risky, quote unquote, type of loan. So some people will go with this and pick a set number, say 7% of the money that they're going to take out each year, so that it's less variable and they can rely on that. Now, this is going to reduce variance quite a bit. It's generally not going to be a problem at all. You still need to do those annual reviews, because think of it this way. When you're loaning money out, so let's say you had $1 million and you took out $70,000 in tax-free money, you now have $930,000 left. And if the market goes down, now your loan isn't going to be affected. You loaned it at 2%, you also gained 2% over here. Now you do have bonuses that can help with this, and sometimes they'll cover these entirely to where this isn't even a problem. But if it does have to pull from that 930,000, then this number, one, is not only going to decrease a tiny bit, so let's say it goes to 929,000, but also it didn't grow. So even if it's barely any money that actually left, like in this case, just $1,000, usually it'd be less with the bonuses there, the money didn't grow at all. So if we're planning to continue to take 70,000 a year, that's gonna kick us right down, not to 929, but 70,000 off of that. In this case, we're gonna be left with the 859, and now we are trying to produce $70,000 a year for how this money performs into the future based on a starting number of 929 instead of $1 million. So essentially what you've just done since the market went down that past year is you've increased your withdrawal percentage from 7% to about 7.5%. Now this is totally fine. You can keep taking the $70,000 there, but you do just need to keep an eye on this in the case that the market goes down 3 years in a row, like 2000, 2001, 2002. You're way ahead of the other people who lost a ton of money. Maybe they're not even able to take retirement income, but with the indexed universal life, you still might need to lower it a little bit. Your money didn't lose, that's a big win. However, your money also did not grow. So just something to keep in mind here. It's also possible that the money performs way better than you thought it was going to, and you're able to increase this number, but just important to go back and look at this at your annual reviews, make sure you're on track. Now this gets even a little bit quote unquote riskier with a variable loan. Again, as long as you're taking that 6 to 8% number, planning for this in the beginning, doing your annual reviews, adjusting as needed, it's not really even necessary to call it a risk at all. But you have to realize the downside is bigger because the upside is also bigger. So when you take a variable loan, what you're trying to do is loan money out at, say, 5%, but that same money stays linked to the index, so you're hoping that it gains more than that. So if you loan at 5%, hopefully the market gains, let's say 7%, and you just gained a 2% arbitrage on money you've already loaned out. That's awesome. However, if that doesn't happen and the market goes down, not only did the same situation we just described above happens to where maybe your account value didn't really lose money, but it also didn't grow. So now maybe you need to tweak it just a tiny bit in those early years. But also in this case, if the market goes down, you gain 0% here, but you still have to pay that 5% on the loan. So in those early years, it's still very small. In this case, instead of losing just the $1,000 with the standard loan, you also would have to pay the 5% on the $70,000 you already took out and then hope that that rebounds in the future years. So one thing that your agent can always keep an eye out for as well is if this is the case, you're getting to a point where you think, I might just want to switch this over to a standard loan, you can switch your loan types usually about once a year. So you can come back at your annual review, say, hey, I've got a lot of money in my variable loans here. They've done well. I understand the projection, but I'm so fine with how much money I'm already taking out now. I'm fine with just switching it to a fixed or a standard loan and just rolling with that. That's always an option. And here we'll just give a quick example in case that was a little confusing. But let's say again, you had $1 million there in surrender value. You took out $70,000 and the market went down. Now with indexed universal life, we would hit our floor there of 0, so that's great. We didn't lose anything, where if you were in this index, you might have actually lost money. So we're still sitting at 930,000. Now, the problem is we loaned this money out at, again, let's just say it's 5%. So there's an extra $3,500 that's going to get added to our loan balance. And where is that going to be paid from, or where is that going to be taken off of? Well, it's going to be taken off of the amount of money we can access. That is our surrender value. So instead of this number just reducing to 929, for example, now it's going to reduce to, that's 925.5. And if we're going to take $70,000 from that number, it's like increasing not from 7 to 7.5, but from 7 to say 7.6. So just a little bit higher, there's a little more variance there. The upside of this, the reason anyone would do this to begin with, is if you were loaning at 5%, yes, the loan value would still increase to that 73.5K, but hopefully if the market went up 10%, that same 70,000 you gained a little bit of a spread on, you netted 2%. So this money, you had to pay 5% on it, but you gained 7 over here. So you made 2% on the money you loaned out. And now perhaps you could even take more money. You just need to look at the numbers. You need to see what other streams of income you have, your lifestyle, how that might change. Be flexible with this. Index universal life generally isn't going to be someone's only form of retirement income. You can couple it with a couple other things. So main point here to emphasize again, as long as you are doing your annual reviews and keeping an eye on that loan balance compared to the accumulated value, if it's a standard or a variable loan, how many more years you want to take this income, how much, what's your life expectancy, and making small tweaks there as needed. If you do even need to make any tweaks, you're gonna be completely fine. Hopefully this video was helpful, a little more technical video here. If you'd like to take a look at what retirement income tax-free might look like for yourself, book a 20-minute quick consult there down below with myself. I'd be happy to help out.